Today I'm going to be breaking down 3 different stages traders get stuck in. Traders with low level psychology always try and make the jump straight to being profitable. All they're thinking about is passing challenges, getting funded and making money. Now, traders in this stage can make the jump to this one very easily by cutting out middle trades. Traders in this stage, if they actually focus on not becoming profitable and trying to move into this stage, would hugely speed up how long it takes to become profitable. So I'm going to be breaking down all 3 of these stages in the video, the equity curves, the psychology behind it. This is genuine practical advice that will actually allow you to move towards becoming profitable at a much quicker rate. When I first heard the phrase about cutting out middle trades, I was in this stage as a trader, and within 1 or 2 weeks I was instantly moving into this stage of my equity curve, becoming profitable over time rather than staying stuck at break even. Now, 90% of traders are actually stuck in this stage, so this will be the most helpful one for you guys. With that being said, let's jump into the video. Now, I'm going to break down what these middle trades actually are. There's kind of 2 reasons behind this. One is psychological and one is technical. Now, middle trades refer to something that psychology, for the most part, you don't really want to take. You're unsure of taking, you're not too certain on if this position matches all the criteria, if it's high quality. Maybe there's a part of you in the back of your mind that knows you shouldn't take this position. But what happens before we have psychology in check is that we often give in to this desire to trade. The mind wants to do something. When you first come to the markets and you just have the psychology of a normal human, it's not designed to succeed in trading. So we have to get past this first stage. Now, what is the difference in an equity curve of a break-even trader? This might be someone who completely knows the strategy. In backtesting, they can easily be profitable, but in the live markets, they can't execute. Maybe psychology takes a hold. Maybe the technicals just don't feel the same and they don't really understand why. Now, a break-even trader, they can be at a stage where they essentially have the same thing as this, but it doesn't increase over time. So, they can take winning trades in their strategy, they know what they're doing, their equity curve can start to increase, but it comes back down again in the same place, they're having wins again, and they're giving it back with the same amount of losses. So, depending on your risk to reward, it will either be an equal amount of losses or more losses, and something like this can just take place where they're just kind of going between 2 phases, being profitable, being unprofitable, taking losses, taking break-evens, and it's just exactly the same all round. Now, most break-even traders, if you're at that level technical and psychologically, this is what it will look like over 1 year of trading. But they never get to this stage, they always cut it off right here. After 1 month of this, they lose patience, maybe they over-leverage revenge trade and lose an account or pass an account. They don't have the patience to carry out a proper edge. The problem with this is that they now never get to actually see where they're going wrong. Maybe over here after 3 months, they were going to learn a crucial lesson that results in them having a breakout and switching to that profitable equity curve. Maybe it was going to happen after 6 months, but the point is, if you don't have the discipline to even carry this out in the first place, or the patience, you'll never get to the stages where you have these breakthroughs and these crucial lessons. Now, many of these trades right here will be what I call middle trades. A break-even trader a lot of the time is just on the edge of having enough discipline if they do actually carry this out for this long, just on the edge of having enough discipline where they don't revenge trade, over leverage, or put on high risk and pass or blow an account in one trade, but they do give in time to time, having weak psychology in taking what I call middle trades. This might be a trade, it's maybe B quality, a couple things line up, a couple things don't line up, and these trades are killing their profits. If they have the discipline to just ignore these trades, these losses right here might be middle trades, they don't occur. Overall, this person is now profitable, right? They still take standard losers, but they don't take as many losses because they cut out those middle trades. They trade less frequently and more high quality. This is what transforms an edge from this into this. Not taking as many trades and taking higher quality positions, because those lower quality positions eat up your profits. Those are the middle trades right here that we don't want to be taking. So if you are at this stage where you have the psychology to trade properly for a long enough amount of time, but you're stuck within a range of break even, this is almost 100% the case with these traders. Every time in coaching I've seen this is the situation someone has. I see them taking middle trades or low quality positions, and it doesn't allow the equity curve to break out to the upside overall. So if you're at that stage, this is what your equity curve will look like, and middle trades will completely shift you from this stage to this stage. That's what it did for me. Reducing the amount of trades, only taking high quality positions, ones that had the risk to reward potential. I have a lot less losers, and this allows equity curve to grow over time rather than staying stagnant. Now we have psychology at a low level. Now, what this usually means is someone can be in two different scenarios. So I'm going to draw two different ones here. The first one is someone has a high technical understanding, but the psychology is at a low level. This might mean they have a profitable equity curve, right? They can have profits over time, but maybe this loss right here annoys them too much. Their psychology is not at a high enough level, they don't have the discipline. And so this happens. They don't get to learn the lessons, they don't have to let anything play out. This was the case for me. I had high level technicals before I was ever profitable, right? For months at a time, something like this or this would happen with one trade. Because I didn't have the patience or the discipline, I would eventually give in to a spiral of revenge trading or over leveraging. The next psychology at a low level is just purely random. So, one to maybe two trades, they kind of pass an account and they weren't really related to any strategy. They were just looking at the market and they're like, yeah, I think I can see this is obviously going to go here, so I'm going to take this position, loss or win. Super low level psychology, if you're still doing that and not trading within an edge, if you're just looking at the markets thinking, yeah, I can see this is obviously going to happen, without any reasoning behind it, it's not a strategy, that's low level psychology. Essentially, it's giving in to the lowest level of desires, in a sense, our brain has to just do something and get dopamine, and all it's going to do is be confirming your bias, right? If you want to take a position, of course, everyone wants to pass accounts, wants to get funded, and so their brain gives them the bias of, yeah, this is obviously going to happen. This is obviously going to happen. And you start taking these high risk or revenge trades to try and pass the account because you're in that mindset of thinking about passing. Now, when you have this kind of psychology, one of the best things you can do is just only take trades within very, very small amount of specific rules. Pick 3 rules, 4 rules, and only take these positions. The strategy as a whole may have more rules or more that you can actually take once you're at an advanced level, but that's not the stage you're at right now. You shouldn't be thinking about passing accounts if you have psychology at this level. You should be thinking about fixing that. The way to fix it is by introducing discipline very strictly and carrying this out over time. If you only have, maybe there's 3 setup types within your strategy that you can take with some rules here that can be applied and, a little bit of more advanced rules where sometimes you don't apply this, just don't do that yourself. Only take that one setup type where these specific exact rules line up. Don't close early, only let stop loss or TP play out, whatever happens, happens. You might not be profitable after this. The goal is not to be profitable, but what this can do is move you out of this stage into the next stage. So essentially what we're going through here is kind of like a ladder of moving between each stage. This is what I recommend for anyone at the low psychology stage, because you're not trying to go on a jump from here to here and be profitable. You're trying to get to that break-even stage, that discipline stage, where what you need to do is focus on the technicals because your psychology is already in check, where you have to cut out these middle trades and then have the profitable equity curve. That's what you need to do at this stage. If you're at this stage, don't try and make one jump to being profitable. It's not going to work. You need psychology first. There's no way around it. This stage is more difficult and more important than going from this stage to this stage. So that's what I recommend for anyone in the psychology low level stage, right? If you manage to fix this and move to the break-even stage, that's great. Don't make it your goal to be profitable, right? If you're only thinking about passing accounts, you want to make money, this is going to be constantly trying to skip this jump from this stage to this stage. And what this results in is actions, over leveraging, revenge trading, passing, blowing, just random results every time. You don't want to be at that situation. So slow things down. Don't try and become profitable. Simply try and make it to this stage. It's a massive shift in terms of what you're focusing on that will hugely improve your trading and hugely improve the speed it actually takes to then get to this stage. Now, this is a profitable equity curve. What we first have to understand looking at this is the time frame between something like this happening, what you actually have to go through and be able to handle psychologically in order to trade consistently long term. The first thing is, when we're looking at an equity curve like this, something you have to note is that everyone's equity curve can look different in terms of time frames, but if it's profitable, as we know, of course, it's always going to be moving to the upside. The main thing with this, though, is the actual time frame when it's not moving to the upside. This is what most people fail to understand and actually visualize. If someone is trading realistically, any sort of strategy that's actually profitable long term, they're going to have months at a time where the equity curve might not be increasing. For me, this happened earlier on in the year when we had the Trump market conditions, and for my strategy personally, and most strategies out there, nothing was really working. This often results in either something like this may be 2 months straight of downwards movement. Something like this This could be 3 months straight of winning, but then kind of having losses, putting you back at that same point. But we also see here, this might be 3 months straight, and when you eventually break out of that into more profit, you can just have a losing streak that puts you straight below where that baseline was. This is something you have to be able to handle. Let me check this alert quickly. There might be a trade coming up. Okay, EU demand. Nice liquidity on this one, but position-wise, this is not very good. Okay, yeah, it's invalidated. So no trade right here. But yeah, coming back to this, what we were looking at here was essentially the time frame between things. Most people don't understand how long it actually takes, how much psychologically you actually have to be able to handle. To be at a stage where you can handle 3 months of maybe nothing happening, and then as soon as you break out, maybe you have a losing streak that puts you below that baseline. This could be 4 months straight. Most people come into trading, they can't even handle one loss, one missed trade. This type of thing might make them angry, might make them spiral, revenge trade, over leverage, all this type of thing from one loss. An actual profitable trader has to be able to handle months. These are the levels and the differences between someone trading realistically and someone not trading realistically. Now, most of the time you're going to have normal or very good market conditions. So times like this, when your account is just increasing, this might be 3-4 months straight, every month is just coming out profitable, a little bit of drawdown here, and just continuing. This will happen most of the time if you have a good edge, but you have to be able to handle these times when it doesn't take place. So hopefully that video was very helpful for you guys. If you are interested in any more psychological breakdowns such as these, check out the link in the description, the Discord. I also put my trade signals, break down the strategy in there, everything as well. With that being said, that's the end of this video, and I'll see you guys in the next one.